If disaster had a heartbeat, you wouldn't hear it crash, it would whisper first. For over 700 days, from October 2022 to December 2024, America lived under that whisper, the longest yield curve inversion in modern history, longer than before the 2008 collapse, longer than before the dot-com bust, longer than even the panic of 1929. And every major recession since World War II has started with the same sound, a quiet, relentless inversion in the bond market. Most people don't see it coming because it doesn't announce itself. There are no flashing lights, no breaking news alerts, just a slow reversal, short-term interest rates rising above long-term ones. In simple terms, it's when investors would rather take safety today than risk tomorrow. Economists call it a yield curve inversion, but history calls it a warning. Every major crash, the Great Depression, the 1970s stagflation, the 2008 financial crisis, was preceded by that same signal. Since 1960, it's predicted 8 out of 9 recessions, with only one false alarm. This time, the signal didn't just appear, it stayed. Day after day, month after month, for more than 2 years. That kind of endurance doesn't whisper panic. It screams it. To understand the danger, think of the yield curve as the market's vote on the future. When short-term rates cost more than long-term ones, it means investors don't trust what lies ahead. They're willing to lose potential profit just to stay safe. And the longer that fear holds, the bigger the storm that follows. That's exactly what happened in 1929. The yield curve inverted months before the crash. The stock market ignored it. Prices soared, optimism reigned, and everyone thought the boom was unstoppable until it wasn't. Within 3 years, markets had lost nearly 90% of their value. The same pattern repeated in 2008, an inversion in 2005, years of denial, and then collapse. Now, history is repeating itself again, but with one chilling difference. The 1929 inversion lasted 18 months. The one before 2008 lasted 10, ours, over 700 days, twice as long as the signal that preceded the Great Depression. It's not just the signal, it's what it means. A long inversion tells us the Federal Reserve has kept interest rates too high for too long. Banks pull back, loans dry up, businesses delay investments. The economy starts to choke itself quietly, while the pressure behind the dam builds. And when that dam breaks, the damage is not gradual, it's catastrophic. This time, the pressure is worse. For a decade, interest rates were near zero. Trillions of dollars were printed. Asset prices soared far beyond logic. When the Fed finally raised rates to fight inflation, it triggered the longest inversion on record. Now, that inversion is ending, but not because the economy healed. It's ending because the Fed started cutting rates again, trying to prevent the very recession the inversion warned about. The result? Cracks everywhere. Consumer debt has hit record highs. Credit card balances have passed $1.2 trillion. Delinquencies are climbing. Corporate debt is coming due just as borrowing costs explode. Bankruptcies are quietly rising. And yet, the stock market still celebrates, pretending the danger is over. But history says otherwise. Every inversion ends the same way. And the clock that started ticking in 2022 is still running. The most dangerous part of any storm is the calm before it. Right now, that's where America stands, between denial and impact. The yield curve may have normalized, but history warns that recessions usually strike 6 to 18 months after the inversion ends. We're now inside that danger window. Every indicator is flashing quietly. Consumer debt has exploded. Credit cards are maxed out. Auto loans stretch beyond 7 years, and delinquencies are doubling. People are borrowing just to survive, not to grow. Corporations that thrived on a decade of free money now face an impossible reality, refinancing their debt at triple the cost. Many can't. Bankruptcies are beginning to climb again, slowly at first, then faster with each month. It's a chain reaction. When companies cut spending, workers lose jobs. When jobs disappear, consumers stop spending. And when spending falls, the illusion of growth collapses. That's how recessions feed themselves, one failure fueling the next. Yet, the stock market pretends not to notice. Investors cling to optimism, convinced that technology and government rescue plans will rewrite the laws of economics. But history doesn't change its rules for anyone. In 1929, the same confidence blinded investors until the market lost nearly everything. In 2008, people said housing prices could never fall nationwide until they did. Today, we hear that artificial intelligence, record profits, and innovation will save the system. It's the same illusion in a new disguise. The bond market doesn't lie. For 700 days, it warned that something was breaking beneath the surface. Now the question isn't if the reckoning comes, it's how severe it will be when it does. Every crisis begins with disbelief. The numbers are there, the signs are visible, but people convince themselves it's temporary. That's exactly what's happening now. Credit is tightening, savings are shrinking, and confidence is fading. Yet the headlines still call it resilient, the same word used before every collapse in modern history. Corporate America is already feeling the strain. Companies that once relied on cheap debt are trapped paying more to borrow less. Profits are falling, not because business is growing weaker, but because the cost of survival is rising. To keep stock prices afloat, they buy back shares, cut expenses, and delay layoffs. But that can't last forever. When the cuts finally reach the workforce, unemployment will surge, and by then, it'll be too late to react. Meanwhile, regional banks are sitting on billions in unrealized losses from long-term bonds that lost value as rates rose. They're technically solvent on paper, but one wave of panic could expose how fragile the system really is. Commercial real estate is another ticking bomb. Office towers half empty, rents unpaid, loans coming due. It's the same fragile foundation that made 2008 inevitable. Yet, this time, the scale is bigger. Government debt is at levels unseen in American history. Every crisis is met with more spending, more printing, more delay. Each fix creates a larger problem waiting in the shadows. The yield curve's warning isn't about one sector, it's about an entire system stretched to its limits. The bond market has already spoken. For more than 700 days, it flashed the same warning that preceded every great collapse in modern history. Now that signal has gone quiet, but quiet is not comfort. Quiet is the breath before the fall. The curve has normalized, yes, but history is mercilessly clear. Recessions don't begin when the inversion starts. They begin when it ends. And that's where we are now, standing at the edge of something vast, uncertain, and potentially devastating. This is the calm that fools nations. The data still looks fine on paper. Job reports remain steady. The market hits new highs, and the headlines reassure everyone that this time is different, but the same optimism was written in the newspapers of 1929. The same confidence filled the halls of Wall Street in 2007. Every great collapse begins with belief that the rules of history no longer apply. But they always do. The economy isn't just numbers. It's emotion, momentum, and psychology wrapped in mathematics. When fear replaces faith, money moves differently. Investors pull back. Consumers stop spending. Credit tightens like a noose. The system that once looked unstoppable suddenly freezes. That's the moment when a correction becomes a crisis and a slowdown turns into a collapse. And this time, the ingredients for that collapse are already in place. Government debt has reached levels unimaginable just decades ago. The U.S. now borrows trillions simply to sustain daily operations. Every new crisis, pandemic, conflict, or inflation demands more spending, more debt, more printing. But every dollar printed weakens the next one. Inflation may fade for a moment, but its shadow lingers, waiting to return stronger. Banks are quietly absorbing massive unrealized losses. Commercial real estate is cracking under vacancies. Families are stretching credit cards just to afford groceries. Businesses are laying off staff quietly to keep stock prices steady. This isn't resilience, it's desperation dressed as stability. Meanwhile, the Federal Reserve faces an impossible dilemma. If it cuts rates to avoid recession, it risks reigniting inflation. If it holds rates high, it suffocates growth. Either choice tightens the vice on the economy. And when policy becomes a trap, every move accelerates the next downturn. Global forces make this storm even more dangerous. Energy markets are unstable, supply chains fragile, and geopolitical tensions rising. The US dollar's dominance is being questioned for the first time in generations. As nations like China and Russia build systems that bypass it, central banks worldwide are buying gold, not faith. Billionaires are buying farmland and citizenships, not stocks. The people who understand risk aren't waiting for headlines, they're preparing for survival. This is what the yield curve was warning about, not just a slowdown, but a global reset. When the pressure that's been building for years finally releases, it won't stop at one sector or one nation. It will ripple across economies, across currencies, across generations, and yet, in that chaos lies clarity. Every great reckoning reshapes the future. The Great Depression built the modern financial system. The 2008 crisis redefined global policy. The next collapse, whatever form it takes, will do the same. It will destroy illusions, expose fragility, and reward only those who listened when the whispers began. Because the yield curve doesn't predict doom for its own sake. It simply records truth. A truth markets refuse to face until they must. The truth that nothing can rise forever. That debt has limits. That confidence is not a substitute for stability. So when the next headlines break, when markets tremble and optimism vanishes, remember, the warning wasn't hidden. It was right there, for 700 days, written in the curve, screaming through the silence. The question was never whether disaster could happen. It was whether anyone would believe it before it did. And now, the countdown has begun.